Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the lagging and the leading indicators in the Forex market. These powerful tools can significantly impact your trading strategy and potentially improve your results. You will learn the key differences between these two types of indicator, how they work, and when to use them effectively. So by the end of this video, you would have a clearer understanding on how to incorporate these indicators into your trading approach. Whether you are a beginner or an experienced trader, this information will be valuable for refining your market analysis skills. So let's get started and unlock the potential of lagging and leading indicators in Forex trading. So we start by understanding what lagging indicators are. And lagging indicators are technical tools used in Forex trading to confirm price trend after they have already started. The key word here is after they have already started. They rely on historical price data to help you identify whether a trend is strong or likely to continue. Because lagging indicators look at past market movement, they provide signals only after price direction is clearly established. This makes them reliable for confirming trends, but it is also means that it can slow the signal when reversing a trend. For instance, the moving average is one of the most popular lagging indicators traders use. A moving average smooths out price data over a specific period, allowing you to clearly see the overall direction of the market. If the price consistently stay above the moving average, it means that we are in an uptrend. Conversely, when price continuously stays below the moving average, it means we are in a downtrend. This is typically what the moving average is all about. When it stays below, we are in a downtrend, as we can see in this area. Once price is below the moving average, you are in a downtrend, and when price gets above, you are in an uptrend. Another common lagging indicator is the MACD indicator, the moving average convergence and divergence indicator, which helps you to confirm momentum shifts in the market by comparing two moving averages. As you can see, these two moving average on the MACD indicator. This is typically how it helps you to compare momentum, confirm the momentum shift. However, because of lagging indicators react only after price movement has occurred, they often lead you to enter or exit trades later than ideal. This means you might miss out on some early profits or get into trades when the trend is almost losing steam. To overcome this limitation, traders usually combine lagging indicators with leading indicators of other analysis tools. This combined approach help you to confirm trends more accurately and make more better informed trading decision. In summary, lagging indicators are valuable tools for confirming established market trends and providing reliable signals based on historical data. While they may not help you catch the beginning move of the trend, their strength lies in the ability to confirm that a trend has truly taken hold. So these are typically what lagging indicators are all about. Now let's talk about what are leading indicators. Now, leading indicators are powerful tools in forex trading that aim to predict future market movements before they occur. These forward-looking metrics provide insight into the potential price trends, helping you to anticipate market reversal or breakout. By analyzing current market condition, leading indicators offer signals that can give you the edge in your trading decision. One popular leading indicator we can talk about now is the relative strength index. The relative strength index is a very popular leading indicator. The momentum oscillator measures the speed and change of price movement, helping you to identify overbought and oversold conditions in the market. When the RSI reaches extreme levels, it suggests that the price reversal may be imminent, allowing you to prepare for a potential trade opportunity. Another useful indicator is the stochastic oscillator, this indicator down here. This tool compares current price closing price its price range over a specific period. By doing so, it helps you gauge momentum and identify potential turning points in the market. When a stochastic line crosses, once it crosses, it signals a potential trend reversal, giving you heads up before the price eventually change direction. So we are meant to be looking out for when the lines of a stochastic indicator cross. This is to spot a potential market reversal. This is why they are called leading indicators. It is important to note that while leading indicators can provide valuable insight, they are not infallible. These indicators can sometimes give false signals, especially in choppy or sideways moving markets. So giving you the opportunity to enter trade early and potentially maximizing your profits. These are the potential they can also offer. So you have to always medicate your risks. You have to always remember that whatever trade you are trying to enter, or you are trying to execute, you always manage your risks, because none of these indicators are worth putting your trust 100%. They are meant to be a guideline to help you to trade in such a way with confidence and with a knowledge of what is going on in the market. In summary, leading indicators are essential tools for forex trading. They always offer the opportunity to anticipate market moves, giving you an opportunity to enter trade early and potentially maximize your profits. However, it is crucial to use them wisely in combination with other analytical techniques to make informed trading decisions. Now let's look at the key differences between the lagging indicators and the leading indicators. Now that we have explored both the lagging and the leading indicators, let's dive deep into their key differences. Understand the distance that would help us choose the destination that would help us choose the right tool for our trading strategy. First of all, the primary difference lies in their timing. Let's not forget their timing is the major difference. The lagging indicators, which are the moving average and the MACD, they always confirm trends when they have already begun. They confirm trends when they are already started, while the leading indicators attempt to predict future. They attempt to predict the future movement of the market. The fundamental distinction affects how and when you should use each indicator type in your trading. And if you can see this leading indicator at this area, it has already peaked when we are expecting an oversold region, meaning when it's oversold and the RSI, you are expecting an upside in the market. And as you can see in this area, the line of the stochastic oscillator crossed at the same point when we are expecting price to reverse, giving us a futuristic advantage. These are the benefits of using a leading indicator, while the lagging indicator is when the price has already started the bearish move before you see price go below the moving average, or you see the MACD crossing below the zero line. These are their key differences. Lagging indicators such as the moving average and the MACD are based on historical data and provide signals after a trend has been established itself. They are generally more reliable and stable, making them ideal for traders who prefer a wait and see approach. However, this reliability comes at the cost of potential late entries into trade. While the leading indicators like the RSI and the stochastic indicators react quickly to current market conditions and aim to forecast future price movement. They can provide early signals for potential trend reversals, breakouts, and allowing you enter the trade early before the predictive power comes into the higher time frame. But this predictive power comes with a higher risk of failed signals, especially in a sideways moving market. If you look at a sideways moving market, we will see that it comes with a lot of false signals. At this area where market is moving to the sideways area, we can see that it's giving us a lot of fake signals. Buy at the cross. If we buy, it will be a short term buy. Sell at this area. If we had sold at this area, we wouldn't have reached our take profits before the market reverse on us. This can be the fake signals it can give us in a sideways moving market. Always remember this important note that neither type of indicator is superior. The most effective trading strategy often comes when you combine both the lagging indicators with the leading indicators. This is when the best trading signals come together, because the lagging and the leading indicators, when combined together, balances out their strengths and weaknesses. By using them together, you can potentially get early signals from leading indicators while using lagging indicators for confirmation. Remember, successful trading isn't about finding a single perfect indicator, but rather about understanding how different tools work together to provide a cohesive view of the market. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe, and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thanks for watching, and I will see you in the next video.